Parity Land. This is Justin from Risk Parity Chronicles with another quick tutorial about withdrawal rates. So there's more in the post, but just so that we're all clear, in case you're just watching this video, we're going to talk about two different types of withdrawal rates this time. The first one is safe withdrawal rate, and that is the amount that you can withdraw from an account in a investment portfolio without running out of money over a given period of time. So it has to be time limited, and you may have less than you started with, but you'll always stay above zero. And secondly is perpetual withdrawal rate, and this is the amount you can withdraw from an investment account each year without going below the amount that you started with. So this one doesn't have as much of a time frame, as we'll see, and this is the one I will be using for the most part. So couple things to keep in mind. The safe withdrawal rate will always be higher than the perpetual withdrawal rate. So you can see how they work when I show you the different graphs. The perpetual withdrawal rate is more conservative since it has this built-in margin of safety as well. Since, let's say, if you start with $1 million and you use the perpetual withdrawal rate, what you're saying is you won't go below that. Well, you probably won't go below that $1 million. So that gives you a little bit of cushion because even if you sort of fail at the perpetual withdrawal rate, you'll still have that money there. All right. Other things to notice, the safe withdrawal rate goes down over time, starts off very high. If you have a time frame of 2 years, it'll be around 50%. Well, probably a little bit higher because you should be expected to go up over time. But yeah, you're going to have a really high number at the beginning. The perpetual withdrawal rate, meanwhile, starts at zero and can not even exist for some 10, 12, 15 years before it kicks in. And then the perpetual withdrawal rate goes up over time as you lengthen the time frame you're looking at. So that means with the perpetual withdrawal rate, you don't need to worry as much about outliving your portfolio. Now I say as much because no matter what your withdrawal rate is, there's still always the possibility of a catastrophic event. But we're using these estimates based on historical returns, and don't read too much into them. They're not laws of physics, but with the perpetual withdrawal rate, you do get a little bit of conservatism and safety in mind. So for all of these reasons, when talking about withdrawal rates, I prefer to use the perpetual withdrawal rate. Now, mostly out there on Twitter land and in sort of personal finance discourse, you'll hear more about the safe withdrawal rate, which I don't think is the right number. So if you hear about the 4% rule, usually they're talking about the safe withdrawal rate, saying that that's what you can take out and still make it to the end of your life with a positive balance. But I think it's better to focus on the perpetual withdrawal rate. So with the 30-year perpetual withdrawal rate, you'll get the most conservative number. That I'll be showing you. Of course, if you went down to a 20-year, it'd be even smaller. But of the ones I'll show you, a 30-year time frame with the perpetual withdrawal rate will give you a pretty safe number. Now, no guarantees. No guarantees. Okay, so how do you find the safe withdrawal rate and the perpetual withdrawal rate? So there are two basic ways. I will be showing you how to do it using portfolio charts, and there's two approaches to finding it on that website. And there's also Portfolio Visualizer. Now this one I won't show you with the screencast, but I have left brief instructions in the post. If you're just starting out with investing, I would really recommend you stick with portfolio charts. It's more visually intuitive, a little bit easier to use. Okay, so I'm going to show you how to find these withdrawal rates for 3 different portfolios. The classic 60-40, which is 60% stocks, 40% bonds. The golden butterfly, which is a 40%, and then 20% gold. And then my own original Risk Parity Chronicles income portfolio, which you can find information about all 3 of these portfolios in the description below. There's blog posts that kind of explain what they are in greater depth. So let's switch over here to navigate to how to find for a classic 60-40. So here I am at the main site. I'll go to portfolios. And with portfolios, you get 2 parts. You get the My Portfolio section, which we'll use in a moment. But they also have all of these presets. And I'm going to use this one here, the classic 60-40. And it's already loaded up for you. You just have to click on this button here called Performance. And you'll get the full performance page for this portfolio. And there you can see what's in it, 60% total stock market and 40% total bond market. It's all the way down here at the bottom. I think it's 2nd to the last. All right, there it is. Now you can see here the default is for 30 years. So let's say you're retiring at 65 and your life expectancy is 30 years. This is what you'd put in for that time frame. Now, of course, we don't know when we're going to die, so that makes this just an estimate here. But over the 30-year period, you'd have a safe withdrawal rate of 4.4% and a perpetual withdrawal rate of 3.4%. And I'd like to call your attention here just to see how these curves move. As you can see with the perpetual withdrawal rate, you don't have any rate that you can count on for 11, 12 and a half years, right? That's because there could be a market crash just as you're starting, so it can't calculate it. Once you go through enough years where if there were a crash, you could get back to your original one, that's when you see this perpetual withdrawal rate start to rise. Meanwhile, the safe withdrawal rate started up here at year one and, well, maybe there at year one, and has gone down every year. And eventually these two will get very close together, but they will never reach. Okay, so if you want to change the time frame, you can just go up to here and click in 40 and you'll watch that the safe withdrawal rate goes a bit lower and the perpetual withdrawal rate goes a bit higher. Boop. Oh, there it is. Okay, so 4.1% down from 4.4 and 3.5 up from 3.4. So if we go here back to the slideshow, you can see right here, that's where I have these two numbers. All right, now let's take a look at another portfolio, the Golden Butterfly, and this is 20% US total stock market, 20% small cap value, 20% long-term bonds, 20% short-term bonds, and very importantly, 20% gold. And we'll see what happens with this. Okay, so this time we'll go here to the Golden Butterfly. And once again, click on performance. And you can take my word for it. It's down there at the bottom, and the screen, the key screen looks like this. All right, so you can see quite a big jump from the classic 60-40 up to the Golden Butterfly. And really what that is the magic of gold as a non-correlated asset has really helped to smooth out. Now, I'm not going to go into too much detail here, but the average rate of return is probably around the same for both, but you're getting a much higher withdrawal rate for the Golden Butterfly based on the stability of the returns. You're going to have fewer peaks and valleys with this portfolio, or you should. I can't say I can predict the future, but you should have fewer peaks and valleys and more stability that you can count on to take a consistent rate from this portfolio over time. So really had quite a lot of improvement to what you can reliably count on just by including gold and by having a slightly better mix of stocks and bonds here. All right, finally, let me show you this with one of my original portfolios. Now this one is fairly complicated. I'll show you how to put it in using the different asset classes here on portfolio charts. Now this portfolio involves leverage, so be sure to read about it in the blog. Leverage is not for everybody, and it's a tricky subject, so just take this as a piece of education. This is not a recommendation for you to follow this portfolio, but basically it winds up being this. And what I'm entering there is a representation of UPRO for large cap blend. That's 3 times leveraged. PFF for large cap value. TNA for small cap blend. I've got 15% in EDV, extended duration bond. And I've got 15% in a 3 times leveraged intermediate treasury fund. Got 15% for REITs. I have changed this portfolio since then, but since they don't have utilities, which is what I changed it into, I'll just use REITs the old way. All right. And because I'm taking leverage, I have to account for the borrowing cost there. So I have that as well. Okay. And that's how I would put in a portfolio of my own creation, and then to go back here to save you the scrolling, it is right here, the RPC income. So once again, warning label, this uses leverage. So this is not a portfolio for everyone, but you can see what I've been able to do by increasing some of the allocation to alternatives, and by using a little bit of leverage, and by using some slightly different assets, I've actually increased the expected perpetual withdrawal rate from, let's see, 5.1 up to 5.6 for the 30-year. So the mix of assets that you have in a portfolio makes a big difference. And so as you think about withdrawal rates, and someone says the 4% rule doesn't work, or the 4% rule does work, which either way, you have to really think about, well, what's the portfolio that's getting you there? And I think there's a lot of discussion about a simplistic withdrawal rate from a simplistic portfolio, but my question's always been, well, what if your portfolios are a little bit better? What if they're a little bit more stable? They don't necessarily have to return more. They don't have to have a higher average return, but if the profile of how they behave changes, we can have a more stable portfolio. Okay, so summarizing this, I like to use the perpetual withdrawal rate for 30 years, and as that is the most conservative estimate of what rate you can withdraw from if you're talking about retirement. Of course, you go down to 20 years, and that would be even lower number for a perpetual withdrawal rate, even more conservative. The assets you have in a portfolio matter, as you saw, right, going from the 60-40 and then adding a little bit of gold and then a little bit more radical portfolio, you're able to increase the withdrawal rates by changing the composition of what's in the portfolio. Now, I haven't gone over why this is so much here, but you can read about it elsewhere in the blog. The secret is in understanding correlation between asset classes. And what we're looking for with risk parity is non-correlated and negatively correlated asset classes, meaning they go up either at their own pace in their own style, or they go up in opposition to another asset class. Now, there's some warnings with this. Correlation, just like expected returns, is only based on what's happened in the past, and it can't be counted on for the future. So there's nothing that says it has to be this way. Just historically, for example, long-term bonds have most of the time been negatively correlated with stocks. Now, they're not always, so keep in mind that this is not a rule that you can go to the judge with, but this is something to keep in mind as you're thinking about constructing a portfolio. I have a lot more information on portfolios that I've used here and correlation on the blog if you'd like to read more. And that's it. So if you'd like to follow along, riskparitychronicles.com, that's the blog site. You can also email me at riskparitychronicles@gmail.com if you have a question or a comment. I'd love to hear. And also, please follow me on Twitter at RP_Chronicles on Twitter. Okay, bye-bye.